Good afternoon, ladies and gentlemen, and welcome to the Trident Royalties PLC investor presentation. Throughout the presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Adam Davison, CEO, and Martin Page, CFO of Trident Royalties PLC. Good afternoon.
Hi, everybody. Thanks for taking the time to listen to our presentation. And I should flag going into this that obviously this slide deck is 40-odd slides long, so it's available on our website. We certainly won't go through every slide, but we'll try to cover all the most pertinent information. We'll drop off the camera now so that the slide should come up sort of full screen for you. There we go. And just by way of quick background on myself and Trident. I joined Trident at the tail end of 2019 as CEO. I come from a background in mining private equity, and prior to that was in sell-side mining and metals equity research, and before that had a mining operational role. And Trident was a shell company originally listed as Trident Resources in 2018. And then didn't have an active management team until we joined in 2019, and then obviously Trident Royalties then had its initiation when we IPO'd onto the AIM market in June of just last year. And then I'll hand it over to Martin. He'll give his own background, of course, and then let him sort of kick us off on what our royalties before we briefly discuss our current our strategy and portfolio. And then we'll spend most of our time talking about Thacker Pass transaction that was announced just a couple of weeks ago, along with the fundraise. But let me hand it over to Martin.
Yeah, hello there. My name is Martin Page. I'm the CFO of Trident. I joined the company back in November, so I've been here 5 months now. Previous lives, I was mainly a CFO in West African gold, so worked for a company called Toro Gold, which is a private equity-owned Senegalese gold mining company, which was sold in 2019. Prior to that, worked for a long time with Amara Gold, which was also West African. So I was predominantly an operator, so bring a different angle to this than from some of the other guys in terms of their private equity background. So that's me. Obviously, been a whirlwind to get up to speed over the last 5 months, but I feel like I'm going. But this is the test, I suppose. So I think predominantly we've probably got shareholders on the phone, on the line, but I think it's probably worth just covering off what our royalty is relatively quickly. I think probably some of you will know, but otherwise, I think some might be new to the space. So effectively, a royalty is a financial instrument. Effectively, it's a investment upfront for in mining royalty companies. So mining companies, whereby we get a percentage of revenue into perpetuity. There's a whole variety and suite of different types of royalty, but effectively they take a view in terms of percentage of revenue. Sources of revenue, where these come from, there's two different sources. There's a primary source, which is where we fund up front. Might be a company that's seeking some investment at an early stage to do a feasibility study or additional drilling, or it might be alongside some of the primary financing to develop the project. Secondary royalties tend to come from legacy assets or legacy transactions, whereby an asset's been around for a long time and goes through a number of transactions, and a number of people will hold a royalty over that product. Might be the original owner, might be somebody who's transacted it just to keep a bit of skin in the game, effectively. And so often these people are looking for an early monetization on the value of that asset, or they might just not be willing to hold royalties for a long period of time. Might not be their company strategy. So to tidy up the portfolio, they look to exit. And again, we transact on a number of these. I mean, we'll go through the portfolio in a little while, and we can probably point out which ones we've done as a primary written royalty and ones that are done as a secondary acquisition. Okay, and then what are the benefits of owning a royalty or stream? I guess the primary benefit compared to owning a direct equity in a mining operating company is that you get top line exposure. So we have that percentage of revenue in perpetuity, assuming the mine doesn't have to shut because it's a high cost mine that for binary reasons has to close. But we are always just exposed to that top line. So from coming back from a background in operating mines, obviously I've seen the impact of increased costs, increased oil costs, having to do additional drilling to increase the resource, having to have problems with the plant. You may have cost overruns. None of these affect somebody, a royalty holder, who effectively continues to just benefit from that top line. So that top line gives you exposure, I guess, in terms of this exposure to the commodity price, but also, as I just said, most mines look to increase their resource. I think something like 80% of all mines that come on tap increase their resource at some point during their life because there's been such a huge upfront capital expenditure. So that royalty exposure provides that top line benefit, but as I say, you're not directly exposed to capital or operating costs. The other issue there is that a number of what does a mining company do once it has cash? Often there are a number of companies who will pay a dividend, but they do look to do M&A. They obviously look to increase the capital spend. Costs do start to increase. So again, as an equity holder of an operating company, you're slightly more exposed to that, whereas obviously with a royalty company, you're not. The other benefit, obviously, of a royalty is the commodity exposure. Now, the vast majority of royalty companies are spun out of North America and precious metals companies. So you see a number of our peers are TSX listed and very much focused on the precious side. So we believe that there's a certain gap there in terms of being able to provide exposure to a variety of commodities, and you'll already start to see that in our portfolio. The other area where we're looking to benefit as a group is that we're focused on this global idea. We're not choosy particularly on jurisdictions, apart from obviously we want strong jurisdictions. We won't be doing things in too difficult places, but we won't be restricting ourselves to the North American focus that often many of our peers have got. So the other benefit to us, I suppose, is I work for a single asset, single jurisdiction gold mining company. It was a very profitable, good mine, but at any moment, should a serious incident happen, we're very much exposed to that single asset. Now, the benefit of a royalty company, and admittingly, we're a junior royalty, but we've obviously gone from 1 royalty to 12 relatively quickly. There's a much more diverse risk basis for our company, where we're looking at up to over 12 royalties. So whilst we aim to invest in only good royalties and we don't want any of them to fall over, we certainly feel that being exposed to 12 royalties rather than 1 asset is a much broader way of de-risking our portfolio. Okay, I think that's probably 101. What are royalties? I probably covered off more than we necessarily wanted to there, but the next slide is a royalty and streaming company performance. I guess this is just talking about what the bottom line in yellow is the ETF gold miners, and the other lines are Franco, Wheaton, and Royal Gold. Obviously, some majors in the royalty space, but I think it just shows how they have been outperforming the actual operators over the last few years. And I guess that's just shows the benefit in terms of the royalty company valuation increases with scale, and the diversification outperforms these mining equities. Okay, I think at this point I'll pass on to Adam, who's going to cover why Trident step into the gap that this market has shown us over the last year or so. And over to you, Adam.
Yep. Yeah, and I suppose that really is the question. Looking at the results from the poll, looks like we have a number of existing shareholders on the line, which is great. So the natural question we get then is yes, understand royalties, and that all sounds good. Sounds like the best way to get your exposure to the sector. But there are other royalty companies out there in the space. Some have been around for quite a long time. So, what exactly is Trident doing differently? Most pointedly, we often get the question, why did you guys jump out of sort of cushy jobs to take a risk on a royalty startup company? I think this slide effectively answers that most succinctly. When you look at that top donut chart, you can see the breakdown of the global mining sector. We use total revenue. I think this is for 2019. Not whether using revenue or market cap or it doesn't matter too much. Effectively, what you see is roughly a third of the sector is in precious metals, a third of the sector is in base metals. By base, we're talking sort of nickel, zinc, copper. And then a third is in sort of bulk commodities, battery metals, and industrials, and kind of everything else. And that's roughly the breakdown of the sector. But then when you look at the lower donut chart, what you see there is the market cap of the global royalty company sector, and overwhelmingly precious metals focused. And now this isn't too much of a surprise. The mining royalties as a financial instrument in the mining space were largely born in North America and to finance precious metals mines. That's where they had their genesis, and that's still very much, despite it's starting to grow and broaden sort of both geographically and commodity wise, but still very much rooted in that origination. And yeah, as Martin said, nearly all of our peers are primary listed on the Toronto Exchange, and the vast majority are very heavily focused on precious metals. So it's not a small sector. Mining royalties are now very much an established part of the mining finance landscape. You'd be hard pressed to find a CFO of a mining company that doesn't consider royalty financing when they're looking at their financing mix. And the royalty sector, this donut chart at the bottom, is sort of comprised of roughly 70 billion of market cap. So it is a big established part of the sector. Nevertheless, still a sector that's somewhat in its adolescence, in the sense that 10 years ago, you'd have sort of 3 or 4 royalty companies on that list, and now you've got sort of 20 plus. So it is proliferating. Nevertheless, still very much TSX focused, looking at assets by and large in the Americas and in precious metals. And therein lied the opportunity for Trident. We were writing royalties often ourselves in our former lives, and we're sort of left scratching our heads on how do we monetize these. There's not a natural holder for many royalties, either due to the geography, due to the size of the royalty, the ticket size. Many of the royalty companies are quite large and looking for sort of $50 million plus tickets. And then most importantly, with regards to commodity. So it's in those 3 areas that we chose to target. We want to build a portfolio, and we're well on our way to a portfolio that's more representative of the upper part of that chart, something that's representative of the global mining sector, because that's not something that's out there at the moment. You'd actually be very hard pressed to try to pull together a holding of royalty companies that's representative of the sector. By buying a little bit of each different one, you couldn't cobble together that sort of representative holding. So we want almost an index fund like exposure, where an investor can say, yes, I like royalties. That does sound like the best way to get my exposure to the sector. I'm concerned about inflation. We see the printing presses are on at central banks. Want to get exposure to real commodities. Royalties are the way to do that. So to get that exposure, well, I can hold a single share of Trident, and I've got exposure then to the full breadth and depth of the mining sector, across geographies, across commodities. That's really the objective, and that we'll touch on our portfolio here in a few moments, but that is what we've started to execute on. And then really from there, in terms of building up a royalty company, we're not doing anything that hasn't been done a dozen times over by our precious metals focused peers. And I take a lot of comfort in that. So it's, we're out there looking for different assets than they are by and large. But that said, growing a royalty company, it's the same formula. And that formula is you start with one royalty, you add more, you add more. When we IPO'd, we had one royalty. We've now got 12. So as you expand, obviously, each deal should be accretive, so you should see that reflected in the share price, which we are. But then it also lends itself to accretive undertakings, such as introducing leverage, which we flagged in the announcement for Thacker Pass. We're now in the documentation stage on a debt facility. So that means we don't have to go out there and continually raise money to buy royalties. We can start relying on the cash flow from our producing royalties, as well as then tap into the debt markets to offer our shareholders leveraged returns. We can also use scrip. This is hard when you're a new royalty company to sort of have counterparties willing to take your equity. You would have seen our last transaction prior to Thacker Pass was an all equity transaction. And in fact, now our last five transactions have had an equity component to it. So counterparties can see the benefit, in particular, counterparties that aren't the natural holders of royalties, whether it's a mining company or a PE fund, they can see the benefit of swapping out their single royalty in exchange for equity, which gives them exposure to a portfolio of royalties, and also recognizing that a single royalty held by a mining company that's not in the royalties business is not going to get the same valuation as that royalty held by a royalty company. So there's a very natural sort of relationship there with sellers of existing royalties. And then it all effectively leads you to being able to institute a dividend policy. So you're building up your portfolio, you're levering up to continue to build the portfolio. You're being careful with your equity, and ultimately you want to be able to pass that revenue through Trident straight into shareholders' pockets. And so that's what we're aggressively moving towards. And as I said, this model, we're not breaking new ground there, that this is what royalty companies have done by and large over the last sort of 15 to 20 years. And it's worth mentioning on this slide, I won't sort of delve into point by point. I think we've touched on quite a few of them, but you get this sort of second accelerator with regards to returns of royalty companies, in that when you initially start and you've just got a couple assets, you may not be getting full value for those assets by the market. But royalty companies, through the benefits of royalties as financial instruments that Martin outlined, you see this compounding effect with each deal you do. Obviously, it's accretive in its own right. Each deal should be giving a return to, each share of Trident should be worth more than it was prior to the deal. Otherwise, we shouldn't be doing the deal. But then on top of that, as you're building out your diversification, which further de-risks the portfolio, you see that reflected in the overall value of the portfolio. So you're getting a return with each transaction you do, but you're also marching up this sort of progression of being valued from 1 times net asset value to, for juniors in the space, sort of 1.2 to 1.3. And then for the really big boys in the space, they're valued at sort of 1.9 to 2 times. So you see this sort of, you almost get a double kick with each deal you do. You're getting the return of that individual deal, but then you're also getting this re-rate of the entire portfolio. So it's almost a compounding effect. And this really does drive the returns that you see on this slide. It's a little hard to read that chart, but the x-axis is days since inception of royalty strategy. If you've looked at our corporate presentations before, you would have seen this one. I think the difference now is we've added Trident to that list now that we've got a bit of track record. And what you see is with each deal, obviously, you're seeing a nice uptick in share price and performance. But really, the inflection point for a royalty company comes when you do have the size and scale that you're tapping into sort of lower cost leverage, and you're initiating a dividend, you're doing a dual listing if it's accretive for shareholders. So that's really then where you see this sort of real uptick in value. So, we're happy, obviously, to see that as we've progressed, and you can see our share price chart here, as we progress with each deal where we're adding value to the shares of Trident, and that's been reflected by the market. And I think is answering a lot of questions when we IPO'd, would there be interest in the UK? I think given the liquidity we've had and it's only improving, I think we can now say that, you can never answer these things definitively, but you can say certainly moving in the direction we wanted to see it move in. And then obviously, of course, nice to see the share price performing the way you'd want it to off the back of each deal. So we are in that stage where, we're just over 10 months listed now. So still very early. That said, we've gone from 1 royalty to 12. The share price, we IPO'd at 20p as of today. I think we're sort of around 37, maybe 37 and a half. So we're seeing, and all backed by good liquidity and a broadening shareholder base, both with regards to retail as well as in this last raise, which we'll talk to later, adding some real quality institutions in the UK to the register. So everything is sort of moving in the direction that we wanted to see. We'll talk to pipeline later as well, but I think the strategy is proving itself out in the sense that there is just a wall of deals that we can go out there and do, because this is a side of the royalty market that hasn't been adequately tapped into to date. So with that, actually, let me hand it back to Martin, and he's going to talk to our existing portfolio. We won't belabor it too much because I think a lot of material out there on this from past webinars and public releases, but and we do want to get into Thacker Pass and get into the detail on that one, but worthwhile to spend a bit of time on our existing portfolio.
Sure. Thanks, Adam. Yeah, as Adam says, he'll focus on Thacker Pass shortly after I give a brief overview. I think looking at the poll, I think a lot of you guys are existing shareholders, so I'm assuming you're relatively up the curve on some of these assets. I think not completely ignoring Thacker Pass, I think the chart on the right obviously shows us relatively overweight now in terms of the lithium exposure. I mean, it's a very exciting space to be in at the moment. But having said that, back in July last year, the Cooler asset in Australia, which is now 10%, was 100% of our weighting. So we are a growing company, and we expect that chart to move around. But fully aware that at the moment we're exposed to the Thacker Pass lithium asset. So moving on, we've got two producing assets at the moment. We've got the one in Australia, Cooler Nubbing, which is an iron ore deposit in Western Australia, which is run by a major called Mineral Resources, very strong, capable operator. It's a 1.5 NSR on the iron ore from one of the pits. And I think it's coming back to what is the royalties and where do they come from. This is an example of one that's been kind of sat in a drawer for 10 years. It went through a variety of hands, people who've owned the project, people who then looked to own the asset. We came in and last June and launched. Well, it came off the back of the listing. One thing which just wouldn't belabor this, but we came in, we're quite pleased. Iron ore price was about $85. Obviously, at the moment as we're speaking, it's 140 plus, 150 plus. So we were quite happy with how that investment's gone. I'd also like to point out that it cost approximately 6.5 million Aussie dollars, and we're now looking at having clawed back at least close to nearly $3 million potentially in the next quarter. So we're very pleased with that initial investment. Moving on to the next producing assets, Mimbula, which is operated by Moxico Resources in Zambia, which is a copper asset. Again, extremely pleased with where the copper price has gone since the investment. This is an example of when we've actually written a new royalty. The asset, the company is looking potentially to list this year, and it needs some additional cash on the balance sheet. We had a few, it's got reports to always be doing in terms of feasibility studies and costs, and they just wanted to bulk their balance sheet out. Hence, they were very happy to talk to us in terms of providing a bit of upfront cash. So we were the benefit of writing your own royalty is you can also, the negotiations can be relatively smooth, and you can kind of fit how how each party wants it to look. We obviously would like our cash back relatively quickly, so there's a mini semi-debt facility in there in terms of there's a minimum repayment terms, so there's a bit of a debt structure there. If they don't ramp up as fast as we'd hope, then we'll still get our $5 million, which is the initial investment, back within 3 years. Having said that, we'd hope that they can ramp up faster. That depends on access to plant and other issues there. After that initial period, there's a step down to 0.3% gross revenue royalty, which is over $100 million. So 100 million tons of copper, 1% copper, which is be a reasonable length of time, when it then steps down to 0.25%. 0.2%, I believe, actually. But that's a nice looking asset again, and a long-term asset. And I would say the benefit of these two producing assets, they're not huge, but what they do is they more than cover our existing cost base. So even if Mimbula only repays the minimum terms at the moment, we'd expect to fully pay our existing cost base with it, which means that any capital we raise from you guys or any any debt we raise, we can put straight into the projects that we're buying. There's no G&A cost or working capital at this need at this moment, which is not always the case in our industry. Moving down the list, the next two, I suppose, bigger assets are the Pucaquaqua asset, which is a large copper asset in Peru, and the Lake Rebecca Apollo Consolidated Run gold project in Australia. Taking Puca, we acquired this just before Christmas, I think it was announced. We're pretty close to closing on that now. Very large copper deposit owned by a large major Nexa Resources, which is listed in the US. It is on their pipeline to be built. It's a reasonably advanced feasibility study project. It's going to potentially take a few years to come on board, but once it does, it's a real decent payer. There's some upfront payments to us, and then a long-term asset. So that looks a very exciting asset for us. That was acquired from Orion, which the counterparty we just acquired Thacker Pass from. Next one, as I just mentioned, was Lake Rebecca, which is a 1 million ounce plus gold resource in WA, Australia. This looks like a great asset from the price we picked it up at. I think 8 million Aussie dollar, of which 1 million was in scrip. Compared to some of the recent deals that we've seen done, that we think we've got a great valuation on this in terms of, we expect this to be in production in 18 months to 2 years, given depending on how long feasibility studies take. They're a great team that run the project, but equally they're sat between some large gold operators down in Australia, so we fully expect this to either take this to development or counterparty down there to maybe potentially acquire them. But we certainly see this as a great gold asset that we think we've got for an excellent price, and we see relatively few warts on it in terms of its state, its run to development. And then the last few, I guess, is Warrawoona, Spring Hill, Talga Talga, Mosquito Creek, and Bullfinch. These are smaller pre-feasibility stage. I mean, a few of them a bit further along the line than that, and some of them owned by pretty large companies now. But this gives us a decent bit of exposure to some early stage development projects. We do expect Spring Hill to come on in 18 months. A couple of the others have had some certainly good news recently. Oh, one other thing I'd say about Lake Rebecca actually was that we're expecting to see a feasibility study or a new resource, effectively in the next quarter or Q3. But yeah, these other gold assets, there's some optionality there, and we do like where some of them are going. But it just shows we're trying to, not only within our portfolio of commodities and locations, we're also trying to get different stage development. So these are more exploration stage assets. Moving on to the next slide, I think we can now put a slide in. Previously reasonably Australian heavy, but the last two assets deals we've done have been the Thacker Pass one and the copper one in Peru. So we can now proudly show a bit more of a global map. Hopefully, as I say, we're not proud in terms of where we look to do our deals. We won't be doing them in sanction-based countries or particularly difficult countries or ones. But we are prepared to talk and look at some assets that some of our peers are potentially not so keen to look at. But yeah, so it's nice to put in a map, and equally shows where we are around the world. And I'm sat in London and Adam in Denver, so we cover all time bases, and we cover all jurisdictions. Final thing really to say before Adam takes up the reins and takes us through the very exciting Thacker Pass acquisition is we are a low cost model. We hope to build scale. We'll keep doing deals within the constraints of the capital we have and the access to raises. But our cost base will remain relatively low. I came on board. We're now a 4-strong management team with the board. As we outsource certain things such as the legals and other bits and pieces, but I suspect as we grow capacity, we may bring a few people in house as that makes sense. But we don't particularly expect our G&A to rise rapidly, and it's certainly not in line with our expected revenue growth and our general asset growth. So I don't think that the one we usually use is it Royal Gold or is it Royal Gold? I think actually it's down the road from Adam, and multi-billion market cap company. I believe they published their numbers, and I think they're up to about 27 people now. So just to give an example of, despite being a multi-billion company, the numbers are still pretty low, and you just can't see them going much higher. So lean and mean, and I think that we're very happy with that, how that spins out to our equity holders and potential debt holders. Okay, without further ado, I think I'll pass back to Adam, and as I say, talk to the very exciting Thacker Pass project that we acquired in the last month.
Yep, thanks, Martin. Now on to the very exciting bit, Thacker Pass. I may actually go a little bit out of order from the slides if you've reviewed them on our website. I thought it made sense to touch base first, perhaps, on the lithium market. Not everybody may be intimately familiar with it. And obviously, you can spend full days at conferences discussing nothing but lithium. So we'll only touch on it very briefly. But I think a couple key things that were sort of foremost in our mind when considering an asset in the royalties in the lithium space, and summarized very well by the two charts on this slide. So the topmost one, clearly lithium is being driven by the rechargeable battery market, in particular for EVs, but I suppose electrification more broadly. But by and large, that is driven by electric vehicles. And you would see sort of the other uses, by and large, industrial uses for lithium. It's a pretty steady Eddie, unexciting commodity without that rechargeable battery element. But it is that uptake in EVs, which I think we can all conclusively say that it's not a matter of if that will happen. It's a bit more of a matter of when. And even that sort of question is being answered because we're seeing it today, right? The auto manufacturers are releasing their numbers, and we're starting to see a significant uptake in EV models. So I think that's all pretty clear and straightforward. What it means for lithium is it's propelling it, and you don't see this very often, but it's propelling it from sort of a secondary commodity almost in the mining landscape to stepping up into sort of a tier one type of commodity, in the sense that if it was just being used as it has been for these industrial uses, it would continue to be sort of a relatively small market, and it would sort of tick away there in the background. But because of this uptake, it is materially advancing. There are now many multi-billion-dollar lithium developers and producers out there in the world. So it's really taking a sort of position as sort of a primary commodity, which you don't see very often, right? It's hard to imagine a scenario where gold or copper, something would revolutionize demand such that you see such a massive uptick where compound annual growth is 20% year over year for a full decade. That's just not going to happen. So it's an exciting space to get exposure to. Now, then the question, the next natural question is how is this demand being driven? And that's where the bottom chart on this slide comes in. I think as mining guys, we can wrap our heads around the supply side comfortably. You can look at what mines are out there producing currently, which ones are sort of advancing towards construction, what are their production profiles and cost profiles look like. All that's reasonably straightforward. The question of demand is really then an important one, particularly in a space like this, which is a little bit more opaque. So we take a lot of comfort from the fact that when you look at the various battery chemistries out there, and this chart is by sort of component of batteries, lithium is across all of them roughly 10%. And perhaps more telling, a chart that's not on here is if you did this breakdown, the same breakdown, but by cost of inputs into the battery, what you'd see is that some of the other commodities sort of shift wildly or shift significantly in terms of how much of the battery that they actually drive the cost, where again lithium is about 10%. So you've got this position where you want to get exposure to rechargeable batteries and to the sort of once in a generation kind of EV transformation. But then it's getting the right exposure. And that's where we take a lot of comfort in the fact that lithium is a key component of every battery chemistry out there. Even solid state batteries have lithium metal as a key component. And then importantly, it's not the cost driver behind the batteries. So, as you can see, where we're sort of, the world is increasingly shifting from the 422 and 532 and 622 to 811. Sort of that's where we're seeing the sort of next generation of vehicle models shifting towards. And what you see in that is a shifting, engineering out of the more expensive components, making the batteries lighter and making them cheaper. Right? That's what the auto manufacturers and the battery producers need. And lithium is not the driver behind either of those. So it's a consistent component of all battery chemistries as far out as we can see. And I'll talk to Thacker Pass now in a moment, but it's the kind of long life asset, nearly half a century of reserve life, and then twice the resource life on top of that gives you exposure then to that full thematic as it comes to fruition. So then stepping back now to Thacker Pass specifically, it might be worthwhile to give a bit of a history of the royalty, because we didn't acquire this royalty from Lithium Americas, the operator of the asset. They're well capitalized and they don't need funding from us. This was a royalty that was put over this asset in 2013. So it has been around for quite a while, and was put in place at a relatively high risk period in the life of the asset. It was an exploration stage asset at that time, and obviously has advanced considerably since then. So we were aware of the royalty, and had looked at it previously. The challenge we always had was it's a big royalty over a very big project, and Thacker Pass at that time, very interesting, but we didn't feel that it was right for Trident to go out there and source the financing to acquire a royalty over what was one of many, many development stage lithium stories. That dynamic changed entirely in January this year. So in January 15th, Lithium Americas announced that they got their final key permit for Thacker Pass. There's some minor sort of state and local ones for construction outstanding, but they characterize themselves as fully permitted for construction. And then shortly after that, as in days after that permit, they announced a $350 million fully underwritten equity raise. This was subsequently upsized to the maximum amount of $400 million. So they raised $400 million, almost entirely allocated towards construction of Thacker Pass. There's a sort of small carve out for debt service and working capital, but almost entirely it's allocated towards Thacker Pass. So suddenly you have a situation where, very nice looking royalty over development stage lithium asset, but there are many lithium assets out there in the world. And then by the end of January, it was a royalty that's over a permitted, nearly fully funded project that's being advanced by a multi-billion-dollar mid-tier lithium developer. So obviously that changed the dynamic, and we reached out to the counterparty to inquire about the royalty, and picked up discussions where we left them off previously, and arrived at, I think, at a good outcome for Trident shareholders. The Thacker Pass asset, stepping forward to the size of the resource, you can see on the other slide, it's a 46-year mine life. This is based on reserve life. So that is a very, very long mine life. And the resource, as you can see here, is nearly twice the size of the reserve. So it's a significant asset. We would expect it to be around for half a century to a century once this thing is in development. And important to flag on this bubble chart. So this is showing sort of a smattering of various lithium projects, advancing projects. And I think important to point here is, if you remove the projects that are hard rock deposits, those are almost uniformly sort of more expensive producers. So you remove the more expensive guys, and then you remove the assets that are in sort of the more challenging jurisdictions, China and other challenging mining jurisdictions where we wouldn't necessarily be in a rush to get exposure to. Well, what you find is Thacker Pass stands out as being a significantly sized asset with good grade. It just pops out as a tier one global asset. And Martin touched on our existing portfolio. Of course, we love all of our existing royalties and really excited about the potential there. But this is unquestionably our first big tier one global significant asset that we have a royalty over. This thing will be pumping out lithium well past my lifetime. So it's the kind of asset that you just want to get into your portfolio, because you don't see these very often. So a huge amount of excitement, I guess, around this asset, and the fact that there was an opportunity to acquire part of the royalty. You can see on this slide then how Thacker Pass stacks up from a cost perspective, because for royalty holders, that's the key thing, right? you don't want the mine to shut down effectively. If it turns on, even if it's not performing from a cost perspective as well as the operator was hoping that it would, you kind of don't care because you're just taking a percentage of revenue. So as long as they're pumping out the tons that they're targeting, and the lithium price is doing well, then you're seeing what you need to see. And if their margins are tight, well, that's for equity holders to be concerned about. So we take a lot of comfort from the fact that, and these are Lithium America's numbers based on the Thacker Pass pre-feasibility study. It's about a $4,000 per ton of lithium carbonate equivalent cash cost. And then when you bake in the byproduct credits, because, as part of the processing of the lithium, it'll be producing sulfuric acid and Epsom salt and other sort of revenue generating sources. That knocks it down to about $2,000 per ton. And to put that in reference for you, I haven't looked at lithium price today, but it's been ranging from $12,000 to $13,000 per ton CFR China price for the last sort of month or so. So you're looking at a very large, significant global, very defensive asset. So, very exciting one for us to get a royalty over. With regards to logistics, it's located in Nevada in the U.S., which is the global #1 mining jurisdiction per the recent sort of annual survey. And then Nevada is it's right there where most of the U.S. gold production occurs. So Winnemucca down the road is sort of the big U.S. mining services hub. A lot of the Lithium America's shareholders like to flag that the Tesla Gigafactory is right down the road, but whether it goes to Tesla or some other auto manufacturer or battery manufacturer, auto manufacturers are by their very nature very, very domestically integrated, whereas U.S. at the moment doesn't produce much domestic lithium at all. It's sort of less than 5,000 tons, and near-term expectations, near-term as in sort of 2023. So not very far away. Anticipated demand is around 100,000 tons of LCE equivalent, and we don't really produce any by and large. So clearly a massive gap there. A lot of our lithium today comes out of the more expensive hard rock mines in Australia, sent to Korea for processing, sent to the U.S. for integration into the batteries. So a domestic source of production, in addition to potential sort of supply differentials that gives it from a cost perspective, also security of supply from a tier 1 jurisdiction, a lot of benefits to domestic production. And I think more broadly than with the project now permitted and rumbling towards construction, there is a lot of good news that we expect to see coming out of Thacker Pass in the foreseeable future. So they've published their pre-feasibility study in 2018. The definitive feasibility study, Lithium Americas is flagged as coming out in sort of mid-year this year. What we expect to see there, it will be different from the pre-feas. I dare say it'll probably be better. You'd be hard-pressed to find a miner that publishes a DFS that's worse than its PFS. I expect we'll see the product mix change slightly. So at the moment, they've got phase 1 at 30,000 tons of LCE and phase 2 at 60,000 tons. Important to flag that both phases are fully permitted. But they have flagged that phase 1, you might see a different product mix. And I think this is important. They'll be producing LCE. I think that's can be sure of that. They also have hinted that they'll produce potentially lithium hydroxide and lithium metal directly. So I think that gives them the nimbleness then to service various offtake customers. So a pretty important consideration. And from our perspective, potential upside there. Hydroxide it sells at a higher price than carbonate. And is increasingly in demand for battery chemistries. So I think we'll see that DFS come out mid-year and expect to see some good news there. I mentioned offtake. They don't actually have an offtake yet, which is good news for Lithium America's shareholders in the sense that many times you'd find operators of assets need financing, so they sell their offtake early, and they take a discount to do that, but it gets cash in the door to advance their project. Now, Lithium Americas didn't have to do that. So they're now in a bit of a seller's market where they can step back and sell this to the highest bidder. And that's good from a royalty perspective because our royalty is obviously over their revenue. So the fact that they haven't taken a haircut on revenue is great news for us. That said, as they rumble towards construction and first production, you would expect them to announce where this material is going to go to, and I think that will definitely generate some excitement. Similarly, they've flagged that they're evaluating partnerships for construction. There's a lot of excitement around this in the sense that Ganfeng is their biggest shareholder, and that's the second largest lithium producer in the world, the biggest supplier to BMW, and a big established lithium producer. So it's good to have them involved. Is also their JV partner for Lithium Americas asset down in Argentina, which will have first production next year. So they bring a lot of financial and technical support. A lot of the market is considering Ganfeng as a likely partner in that regard. There's also excitement. It could be one of the downstream guys, like a Tesla or somebody else that partners up for development in exchange for offtake. So we're excited to see how that takes shape. And then finally, Lithium Americas has flagged commencement of construction at the end of this year, early part of next year. So that's probably the most significant news flow that we expect to see once this thing starts moving into construction. Well, then we've got the certainty and timeline we need with regards to what that means for our royalty. So just jumping into the sort of metrics behind our royalty. So you would have seen the acquisition was for 28 million, and this acquired 60% of the existing royalty over Thacker Pass, and it's over the entire project. It's uncapped. It's got a 2 kilometer area of interest around the project. So yes, any production out of Thacker Pass, our royalty will have that exposure. Now the royalty is an 8% gross revenue royalty. That said, the operator can knock that down to a 1.75% gross revenue royalty by making a one-off $22 million payment. And I'm talking on a 100% basis right now. So we'd be 60% of those numbers. So their studies assume that this would be exercised and exercised in the first year of operations. As you can imagine, paying 8% versus 1.75 is a bit of a no-brainer, especially if you're a cashed-up operator or developer like Lithium Americas with over 500 million in the bank. It makes all the sense in the world to exercise that. It also makes sense to do that upfront. There's no point sort of paying 8% for several years and then paying the 22 million. To reduce it to 1.75, because that 22 million doesn't get reduced. It's a one-off payment for that fixed amount. So yes, we would expect to see that exercised in advance of first production. No guarantees, of course. If it pays at 8%, that's all the better for us. But yes, we would expect to see that occur, which effectively means we get back 13.2, or our 60% share, when that is exercised. So when the dust settles, we'd effectively be on risk for 14.8 million to about 60% of the royalty. So 14.8 million out the door for a just over 1% gross revenue royalty. We'd be sitting at 1.05%. And in terms of what that means with regards to revenue for Trident, you can see in the blue box on the right, and of course these numbers shift around based on production profile and whatever the spot price happens to be. It's obviously ticked up quite a bit since we completed these slides, but this is indicative in nature. And I think what you'd expect to see is at phase one, on the PFS numbers, you could see that the royalty paying direct to Trident sort of 3 to 4 million US a year, depending on price, production, everything else. And then similarly at phase two, which is in the most recent study anticipated to commence 3.5 years after phase one is commenced, then it would be in the range of 6.5 to 8 million. Today's spot price, it would be about 7.5. So that allows you to, and these are after receiving back the 13.2 million partial buyback. So you can see you'd get sort of the 13.2 back in the first year of operations. Now we flagged 2024 as the first year. This isn't definitive, but flagging their construction commencing end of this year, early next year. And Lithium Americas has said that they see themselves coming to market, in their words, in 2024. So there's potential some production comes out the door in 2023, but materially coming to market in 2024. This is how we'd see the profile on the current PFS. Again, this can change slightly. You can see our existing royalties. This is based on broker consensus. That's the dark blue part of the bar chart. And broker consensus may vary, obviously, from our internal numbers, but gives you a good sense of how we see Thacker Pass layering in over top of our existing portfolio. And so it does a couple things for us. Firstly, from a quantitative perspective, as you can imagine, and based on those rough numbers I outlined for you, I'll save you the trouble of doing the back of the envelope math. It would be sort of a mid to upper teens post-tax IRR. So, and on a mine life of 46 years, to get that level of annual return, year after year after year for decades, that's a pretty powerful number that I think was probably making quite a few of our precious focus peers jealous, because you just don't see that kind of return profile very often. But then qualitatively, it does a lot for Trident as well. You can see, as I've talked a bit about sort of our march towards paying a first dividend. Even if we were to sit on our hands for the next couple of years, which clearly we won't, I can assure you, we've done 7 deals in the first 10 months, so anticipate doing more certainly. But even if we were to sit on our hands, I think what you see is Thacker Pass, when it's in production, it catapults us up to the level where Trident could comfortably support a dividend, as well as service an amount of debt to continue expanding its portfolio using leverage, but also servicing a dividend alongside. That's a pretty important qualitative consideration for us. In addition to fundraise, by bringing in that capital, it nudges us up closer towards the 100 million US market cap. So with that comes improved liquidity. As I mentioned earlier, we got some really high quality blue chip style UK institutions on the register in this round. So a very, very positive impact on Trident more broadly, on top of adding a very accretive deal that sees our NAV per share, on our internal numbers, ticking up above 50p per share. So not fully sort of reflected in the market yet, but I think still being digested out there. So pretty powerful transaction for us, both from a quantitative, obviously, perspective, as well as qualitatively what it does for Trident and our platform. So I'm conscious about leaving enough time here for questions. So just very briefly on pipeline, as I mentioned, we certainly don't intend to sit on our hands here. We're working actively on other deals. The next sort of material market update that we anticipate would likely be within a month or so, and that will be reporting our Q1 revenue from our currently producing royalties. And in those quarterly snapshots, we always like to put out there what we're looking at. Hopefully you see from the active NDAs that we flag on a quarterly basis, some of those are then converting into announced deals. So we see some very positive progress in that regard. And then on top of that, as we build out the portfolio, you're going to see more news flow just organically, right? Martin had mentioned Lake Rebecca will be updating its resource. They flagged Q2 this year. So, we're looking forward to seeing that, but obviously would expect to see an increase in ounces and an increase in confidence, behind those ounces. We're watching Mimbula's progress as they continue to ramp up, and we're seeing good things there. So we're excited about that. Obviously, I flagged the progress we expect to see over the next 12 months with Thacker Pass through the studies, potential offtakes, partnerships, commencement of construction. Spring Hill just got its environmental permit, so that clears the way for it to start moving in the right direction. So we're seeing some organic movement on the portfolio, in addition, obviously, adding new transactions as we go. So with that, I will turn it over to questions, and it looks like we've had a couple flow in, and we had a couple in advance. We'll try to get to all of them if we can.
Fantastic. Adam, Martin, thank you so much for the presentation. Super comprehensive. That's great. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording of the presentation, along with a copy of the slides and a published Q&A, can be accessed via our investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation is ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Adam, as you rightly said, we did have a pre-submitted question, and if I may, we'll start the session off with that. I'll just read it out. It reads as follows. Given current corporate strategy and anticipated deal flow, when do you expect Trident to achieve critical mass with fixed costs static and incremental revenues feeding through to the bottom line? Yep,
that's a very good question. I think the short answer is we sort of feel that we're almost there, or effectively we are there. As Martin flagged, we've got the team of 4. We don't anticipate expanding the team. If we're spending enough on outside counsel and it makes sense to bring that function in house, then that's the kind of step change that we'd see from here. But don't see that happening sort of in the immediate term. So yeah, I think from here, each transaction that adds revenue to our profile, it's just sort of stacking on that on top of where we're at today, and there's not a commensurate increase in G&A. as Martin flagged, it's a very, very scalable business model because we're not operating the mines. So you don't need a cast of thousands. You're acquiring the assets, you're monitoring them, you have them audited from time to time, but by and large, then you're turning your focus to the next transaction. So yeah, I think short answer is we don't anticipate seeing an uptick in our G&A, at least not materially. So from here, it's all sort of accretive in that sense.
Fantastic. Thank you, Adam. And as you say, we've had a number of questions submitted during the presentation itself. Perhaps if I could hand back to you to respond to those where it's appropriate to do so. If I could just ask you to read out the question and just click on that Q&A tab and just run through them, please. That'd be great.
Yep, sure. I think, and sorry, I didn't leave enough time here to answer all these, so I'll try to get through as many as I can. So the next one we had was what type of leverage will you take on, and what ratio is it to your royalty streams? What's the target payout ratio for dividends? So with regards to leverage, we'd flagged that we had a debt mandate for 10 million US, and that's the basis by which we're advancing into documentation. There's always the ability to tailor that, as we need to draw on that facility for a specific deal. You could potentially upsize that. So I don't think it's sort of a fixed number at this stage, but we're moving forward on that basis. So I suppose, it's a little bit fluid, but we wanted to get the documentation done such that it's available to us for our next transaction. That way, as I said, we're not returning to the market, because what you don't want to do is sort of get in this continual cycle of raising money to acquire royalties, and you're expanding your market cap, but the share price isn't moving. That doesn't do anybody any good, including management. We're equity incentivized. So yeah, we want to be able to get leverage into the vehicle. And I think now is the right time. We've got the asset base to support it. So we're advancing that. And then with regards to payout ratio for dividends, it's always a little difficult to reference payout ratios because it's obviously dependent on what your share price is at that time. But I suppose the easiest and most succinct way to flag it is, once we get to sort of that $8 to $10 million sustainable annual revenue, that's where we see turning on a dividend. Because at that level, the business becomes sort of self-perpetuating in the sense that you're generating enough revenue. You can service letting some of that revenue flow out in the form of dividends, but you can still service debt comfortably to continue to expand the portfolio. And yeah, from there you can sort of move forward on that basis. So we're not sort of sitting here targeting, X% per se, but it is looking to maximize that payout ratio while also balancing maximum sort of leverage in the portfolio, and all keeping it sort of sensible and maintainable. Let's see, the next one that pops up is, how competitive was the process to secure the Thacker Pass project, and why do you think you secured it? So on this one, the royalty had been around, as I mentioned, back in 2013. So I may have answered it to a certain extent. And then obviously when it made its, when Lithium Americas made those material advancements with regards to getting the permit and then getting the financing for construction, then it was sort of quickly turning around to the holder of the royalty, Orion, and saying, we reviewed this before, we'd had discussions on it before, it didn't work for us then, it works for us now, so let's pick up where we left off. And I think with regards to competitiveness, there are other parties out there looking at it, certainly, but it does circle back to the strategy more broadly, in that, when you look at the publicly listed royalty space, and just jumping back to our strategy slide now, what you see is, by and large, most are focused on precious metals, obviously. And then you've got a couple guys that are sort of single assets, like Labrador, that are effectively passively managed vehicles, not looking to expand. And then you've got a couple that are sort of anything but precious metals. So, what you find is you're immediately lobbing off sort of 90% of the royalty space by the very fact that it's not a precious metals royalty. So, I suppose short answer is everything potentially is competitive. There are other parties out there. The ability to sort of have that existing relationship and move quickly and having a familiarity with the asset enabled us to sort of get our foot in the door. But But the fact that it's not a precious metals royalty was probably the biggest factor in all of that. Because had this been a big Nevada-based gold royalty, it would have been very, very competitive, and we wouldn't have got it with the sort of return profile that we did. That just wouldn't be available. So hopefully that answers that question. Let's see, the next one we have is, in which jurisdiction is the copper royalty, which we're currently working on? What type of royalty? NSR, gross revenue royalty, and what is the expected cash flow from that royalty this year, next year, etc. Yeah, we'd flagged in the deal announcement and in this presentation as well that we're well advanced on a copper royalty. So it's over an asset that's located in Africa, and the expectation is that one it's in the midst of construction now. It's one of these, an area that's really ripe for a royalty in the sense that it's a private company, and it's a smallish producer, so it's just not right for bank debt financing, right? It doesn't have the size and scale to support that. That said, as a private company, it sort of tapped out the friends and family network to support its advancement. So it was looking for an external source of capital, and a royalty just sort of really fit that profile. So yeah, we're looking at a gross revenue royalty, and in particular, the same way that we did the Mimbula, where it's referencing the LME price. So there's no sort of ambiguity around offtakes and what the pricing looks like associated with where they're actually selling the metal. Now it's just, they produce this much per quarter, and this was the copper price per the London Metals Exchange for that quarter, and times that by the royalty percentage, and that's the revenue profile for the royalty. So a relatively sort of straightforward formula there that removes sort of ambiguity around offtakes. So that's how we're advancing that one, and that one is reasonably well advanced. So we'd be hopeful that we'll have some good news for you, hopefully in the near term. Let's see. Let's see. The next one is, you'd mentioned that the mine operator had flexibility to switch between carbonate and hydroxide and possibly even metal. How does this work, and is the difficulty reflected in the market price differential? Yeah, I suppose the short answer is it'll be sort of fully outlined when they release their DFS. So we don't have any sort of non-public information in that regard. In my comments there were purely based off what Lithium Americas has flagged. I think from our perspective, we see the nimbleness of the operation being able to service different customers is a clear bit of upside. Hydroxide is in shorter supply than carbonate at the moment. That's always subject to change, but battery chemistries are increasingly relying on hydroxide relative to carbonate. So I think from our perspective, would be really pleased to see a project that's producing both, because then it just, as I said, chemistries will evolve over time. I don't particularly trust sort of any firm view of how it's going to evolve. So to have that flexibility built into the project such that you can service any customer for the lithium, I think that just provides a very important hedge for Lithium Americas and ergo for our royalty. So that's how we're viewing it. Let's see. Related to the size of the lithium asset is coming to market likely to adversely affect pricing? The short answer is no. I mean, it is a big global tier 1 project. That said, as I flagged, it's phase 1, at least according to the PFS, is 30,000 tons of carbonate a year, and stage 2 is 60,000. And just within the next couple of years, markets anticipate the U.S. alone needing 100,000 tons, and Europe is probably very clearly accelerating its EV uptake faster than the U.S. and China similarly. So no, don't see Thacker Pass coming online as having rocking the global lithium price. So we're not hugely concerned about that. Let's see, we've got a question here. Can you comment on the legal case over prior claim on the Thacker Pass royalty? There's not too much to add at this stage, which we didn't already disclose in the deal announcement. Really, in short, there's a third party that alleges it had an oral agreement to buy the royalty, and there may be an attempt to join Trident to the litigation due to the remedy that they're seeking. Orion's firmly of the view that this claim completely lacks merit, and based on our diligence, we have the same view. So there's always litigation risk. You see this kind of stuff from time to time. Nevertheless, we do have the protection of indemnity with all sort of standard limitations and exclusions, which is guaranteed by Orion. So we're very comfortable to move forward on that basis. Let's see, and there's been a couple questions related to interest rates and how that would have an impact on our business. I think so. I'll try to answer this to kind of catch all. And there have been sort of 4 or 5 of those questions. So I'll try to answer this to try to catch all those questions, because there have been a couple questions about how would the portfolio be impacted by inflation as well. And I think that all sort of ties in together. And really, this is the reason people get commodity exposure, is to protect against inflation. They're real assets. So people. And you're sort of seeing it. We put a lot out there in social media and elsewhere, and it's not sort of our internal analysis. What we like to do is point to some of the bigger established groups, the Goldman Sachs of the world, and their views on commodities and what they're guiding their clients towards. And it is, yes, the printing presses are on. You can see it sort of in the U.S. alone. The recent 1.9 trillion sort of stimulus bill, and then the $2 trillion infrastructure bill that's being debated at the moment. Those are a big influx of both M1 and M2 money supply, and so that's gonna, in our view, has to have an impact on the value of the dollars floating out there. So exposure to real assets, I guess, is the very clear hedge for that, whether it's real estate or commodities, whether mining commodities or others. I think healthy for a portfolio to have a mix of that style exposure, such that, because effectively when inflation occurs, that's directly reflected in commodity prices. That's why people buy gold and exposure to copper. And you're already seeing it early days. I wouldn't attribute the recent rise in metals prices purely to inflation. I think inflationary concerns, certainly, as well as some of the stimulus, is obviously demand drive for the underlying commodities that have to produce that infrastructure. As we say in the mining space, everything you touch is either been mined or grown. So to build these highways and rail capacity and everything else that's part of these bills, that they're going to need the underlying components, the copper, the iron ore, the lithium to help underpin that. So you see the inflation reflected in the commodity prices. When we did the Mimbula transaction, copper was at about $5,800 US per ton. It has now in recent days been sort of north of 9,000 per ton. When we did our Kulinabi iron ore deal, iron ore was sort of around $85 a ton. Is still hovering north of $150 a ton. And I'd be hopeful that we could say the same thing about Thacker Pass. You've seen it just in this presentation alone. When we referenced the spot price, we were using something in the $10,000 range, and now it's north in the 12,000 range. And I think as this supply shortfall is realized, because when there's been an underinvestment in mining, yes, the markets may turn and there may be this sort of uptick in demand, but it takes time for the mines to get into production to catch up, which is why you have these natural cycles. Is what can happen is there then becomes an oversupply, and then you see it sort of ebb back down, and then you get these natural sort of ups and downs and peaks and troughs. But I think we've been fortunate in terms of getting our exposure by and large at the troughs, which again goes back to the strategy. The fact that our peers are stuck sort of doing precious metals deals by and large, so they either don't do deals if it's at a peak, which isn't an attractive proposition for a public company, or they do deals and they've got very tight return profiles. Whereas we've got the nimbleness. We can say, we're not seeing value right now in precious metals royalties, so let's pivot towards battery metals and base metals. That's where we're seeing value. But, that said, we did 3 precious metals deals in a row because we saw value in each of those deals. So we've got a flexible business model such that we can just target the most accretive transactions. And we're not really at a stage yet where we're agonizing over portfolio mix with regards to commodity. We're just going to target the best deals out there, and over time, then we may refine the portfolio mix, but that's not a concern right now. So I'm conscious that I did run 10 minutes over.
And I think you've also covered off pretty much all the questions there, Adam.
I think so, yeah.
Which is great. And of course, Adam and Martin will review any further questions that are submitted during the course and the remainder of this presentation. Adam, I know you gave pretty much a good summary there, but just if there are any further final words before I redirect investors to give you some feedback.
No.
Perfect. Okay, that's great. I think you gave a pretty much overall wrap. Adam, Martin, thank you very much for updating investors today. Could I please ask investors not to close the session, as you now automatically be redirected for the opportunity to provide your feedback. If you've accessed this meeting from the website, the page will appear, but if you've accessed the meeting via the link in the email, you'll simply be asked just to click on that and log in just to submit your feedback. Please do so. It only takes a few minutes and it's greatly received by the company. On behalf of the management team of Trident Royalties PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you and good evening.